morning to all. In today's session, I'm going to explain about what is all about the balance of payment, what would be the types of accounts that include in balance of payments, and the conceptual framework of money. So let's begin the concepts of balance of payment to reach out the upcoming concepts. So let's begin. Every country, whether it would be a domestic country or whether it would be an international country, has to deal with other countries in respect of the following items. So these three items, the three aspect of the international trade. So the first concept is visible items, which always includes all the types of physical goods which are being exported and imported. For example, tea, vegetables like onion, rice, wheat. So whether it can export and import, so whatever the items which are includes all those services where the export and import are literally not visible. For example, if we are talking about the types of services like banking services, medical services, transportation services, communication services, that kind of all the types of services, banking, insurance services, they're all termed invisible items. The third category is a capital transfer. The transfer which are mainly deals with capital receipts and capital payment. Now the question arises, what are the capital receipts and capital payments? So if we consider the first concept, that is capital receipt. Capital receipt are those cash inflows that which are coming up from a non-recurring activities. For example, like a selling of an assets, like or the borrowings from any bank or any lenders, that are called capital receipts. So whatever the money comes in a business, that are called capital receipts. Now we talk about the capital payments. The capital payments are those money which are, you can say, invested, which are actually the payments which are gone for purchasing a long-term assets, or you can say the cash outflow, the money which are paid for purchasing a long-term assets or any kind of repaying any debt of the businesses or any firms or the family, that are called capital payments. So these are the three main category of the items that the country has to deal with other countries in respect of the following terms. So let's talk about the balance of payment. So what is all about the balance of payment? Balance of payment refers a systematic record of all those economic transactions between the residents or between the residents of a home country or of a foreign countries during a particular period of time. That's called balance of payment. In this particular concept, it refers also a double entry system to record all those transactions between the resident of the home country or domestic country, or and the residents of the foreign country during a year. That's called a balance of payment. And in fact, if we talk about the balance of payment in a very short manner, it refers all those transactions of its citizens and the government. So the government which are dealing with the own country and dealing with the international countries. Same for the citizens, that means the residents of the domestic country and the residents own residents are dealing with the foreign countries during a year, and all called balance of payment. If we include or we maintain such records or the transactions, that's called balance of payments. The another concept which has given a prescribed definition by Reserve Bank of India, that balance of payment of a country refers to all those transactions, economic transactions between the residents of a country and the rest of the world. That means it's record all those receipts and the payments related to the goods and services in terms of export or import, whether the service is received or transferred to the non-residents or the foreigners, that are all called balance of payment, the definition which has been prescribed by a Reserve Bank of India. So it's very simple, meaning is that it includes everything, whether it's related to receipts and the payments of goods and services, the import and export of goods, any payment which has been received and paid in respect of the services and respect of the imports, or any of the money which has been transferred to the non-residents of foreign, and all called balance of payment. If any of the concerned expertise making a systematic record of such transactions, they're actually a real mean called balance of payment. Now we talk about the features of balance of payment. It is a systematic record of all those economic transactions between the one country and the rest of the world. So whatever is going on in the rest of the world, and the economic transaction is, it's mainly deal with the home country, then actually it's called balance of payment, and one of the feature of BOP. It also includes all those transactions which are visible as well as the invisible items. It released during a particular period of time, and it always shows in an annual statement. We cannot consider the balance of payment would be the half yearly or it will be quarterly. No, it is such balance of payment statement would be the annual statement only, and it always follows the debit and credit system. Whereas it also has two sides, credit side and debit side. So when we talk about the receipts, the cash inflows are recorded in the credit side, and the payments are recorded on the debit side. We talk about financial accounting, that means debit what comes in actually and the credit what goes out. But when we talk about the banking system, the rule will be the reverse. That means the receipts will goes onto a credit side and the payments comes to the debit side. Now the next concept is balance of trade. When there is a difference between a country imports and export, then the term arrives or the terms come up with balance of trade. So when we talk about the balance of trade, it's the largest component of a country balance of payment, as it categorized into two sides of item. One is debit side of item and the second one is credit side of item. So when we talk about the debit side of items, it includes imports, foreign transactions, domestic spending, any abroad, or domestic investment abroad. So whatever you are spending anything abroad, you are doing any domestic investments abroad, you are doing any foreign, you can just give providing foreign services, that all comes to the debit side. On the credit side, the items include exports, any foreign spending in the domestic country, any foreign investment in the domestic economy. So whatever the spending and the investments going on in the domestic country and the export as well, it all comes on the credit items. When the exports are more than the imports, that means the balance of trade when termed as favorable. But when the imports are greater than the exports, then it is an unfavorable condition. That means that overall the results will be negative. If the imports are more than the export, if the exports are more than the imports, that means such balance of treatment is on a positive note, on a positive sign. So this is the particular rules that we applied for. So when we talk about the debit items, we always talk about imports. Whatever you can see, we are spending abroad, we are doing investments abroad, we are providing any foreign services to abroad, it all comes on debit side. Credit side, we always talk about export. Any investment comes in the domestic country. Any foreign spending comes in the domestic country. It all comes on the credit side. The next concept is how you distinguish between the balance of trade and balance of payment. So when we talk about the balance of payment consider all the transactions with the all the rest of the world. We talk about the economic transactions with the rest of the world, including domestic and as well as the foreign. But when we talk about the balance of trade, it's related to the import and export only with the rest of the world. Whether from one country to another country, the exports going on, then the import is from foreign country. Any product comes from foreign country to domestic country. That's called import, and that ultimately whatever the trade is going on between the countries where from domestic to international, that particular transaction related to the trade with the rest of the world that all includes in the balance of trade. So there is a big difference between the balance of payments and the balance of trade. Balance of payment include all the transactions with rest of the world, including domestic and foreign. Balance of trade includes all trade, import and export of items only, with rest of the world, including domestic as well as foreign. That's called balance of trade. So this is a difference between the balance of payment and the balance of trade. So when we talk about the balance of payment, it's a very broad term. As I already told, it includes every economic transactions related to all three categories of the items: visible, invisible, and capital transfer. But when we talk about the balance of trade, we always talk about the import and export of items. That means it is called only involve the visible items only and excludes the invisible and capital transfer items. So balance of trade, it is a narrow concept where it only includes all the trade items. That means it includes visible items only. So when we talk about the balance of payment, the balance of payment it always have a balances itself. Where that means if the balances, the huge amount of balances in terms of amounts, in terms of rupees is always available. But when we talk about balance of trade, it could be a positive sign, it could be a negative sign. That means the export would be the more than it would be the favorable. If the imports are more than the export, then it would be unfavorable condition. So this is the what exact goes in the balance of payment where the favorable and the unfavorable situation arises. But in balance of payment, the balance is always be available in itself. When we talk about the balance of payment, the mathematical formula which need to be written down, that is the current account plus capital account, or we just say a balancing amount. That means we are just balancing the you can say the receipts and the payments account equal. So the item that we include, the name of the item is called the balancing item. That the word is called errors and omissions. There would be anything would be omitted or any errors would be involved. So we just consider to become to just keep the equal of the receipts and the payment side. Just consider the term we call the balance items. That is called the errors and omissions. So we just deduct while from the current and capital account or the summation of current and capital account, and that's called the balance of payment. When we talk about the balance of trade, it equals to the net earnings on export and the net payments for imports. That ultimately called the whatever the net earnings on exports comes and the net payments for imports, so whatever the difference comes, that's called the balance of trade. That means a difference between the export and import. So whatever the earnings received on from export and whatever the payments in case of import, so whatever the differences between called the balance of trade. So when we talk about the balance of payment, these are the main factors that ultimately affect the balance of payment. So the first three main factors which affect actually the balance of payment, that is the foreign lenders, because as with the much and much that you take the you can see the borrowings from the lenders, and ultimately on what conditions it would be the interest higher interest rate from one project to another project, and ultimately it influences the balance of payment. The second category, the economic policy of the government. It's very true. The policies it keeps on changing according to the time period, and automatically, economically, it influences the country balance of payment. So if the policies will remain stable and will remain consistent, which will be followed by the various countries during the transactions related to import and export or any kind of the investments and borrowings. So definitely the economic policy of the government will also ultimate impact on the balance of payment. And all the factors of the balance of trade, whether it would be the exchange rate, it would be the whether the raw materials are available on time, whether the prices of the goods are manufactured at the home country like India. So if I am a resident of India, so my country stands for a home country. And if I'm dealing with the another country, that country will also holds stands for the host country because I'm dealing with that country. So, cost of production is also influence the balance of payment. So, whatever the factors of balance of trade will ultimately influence the balance of payment, because import and export items is also included in the balance of payments, because balance of payments is a very broad concept which includes all the three types of items, but ultimately the balance of trade and visible items. So that's why the main factors which influence the balance of trade, that is the cost of production and the availability of the raw materials and whatever the exchange rate between the countries from India to US or the US to China or India to China. So whatever the exchange rate would be the increase or decrease for the transactions, that ultimately it also influences the balance of trade. The fourth concept is the prices of goods manufactured at home. It depends that the prices would be the lower at the home country like India, or would be the higher at the host country or foreign country. So ultimately, it also influences the balance of trade, as the whatever the earnings for export would be the less in case if the prices of the goods would whatever the manufactured at home would be the less one. So ultimately it also influence the balance of trade. So this is the difference between the main difference of the balance of payments and balance of trade. So let's come up the next concept, that is the importance of balance of payments. When we talk about the balance of payment, it has already been stated that it records all the economic transactions. But why it is important? Because it also creates the demand and supply of our currencies, as it always involves the you can say import and export, all the three type of categories, and automatically when it records all the transaction, that means ultimately it always creates a demand and supply of a currencies of a countries. Second importance is it always predict the economic and financial status of a country in a short-term basis. It always predict and always judge whatever the outcomes related to the economic and financial status of a country in a short-term basis. It always be done through the balance of payment, and that ultimately it is one of the important concept in balance of payment, that is the economic and the financial status of a country. When we talk about the third concept, the balance of third importance, that is the balance of payment, always you can see show up a trend analysis of in an economy, international trade, the exchange rates of the country. It always shows when there is a trend analysis that it frequently having a changes or having a non-changes in the economy, international trade and exchange rate of different currencies, then ultimately it also indicate, it also revealed what would be the changes occurring during a period of time, and what could be the solution could be, or the reversal could be taken off in that particular trend analysis or during a period. So this is also the one of the important, the balance of payment is always helps to confirm the trend analysis of the economy, international trade, and the exchange rates of the currencies. But when we talk about the next point, it always reveals that what would be the policy shifts of the RBI of the country, where it's related to the monetary terms, whether it would be the interest rate, it would be the exchange rate, it would be the loan rates. So it depends that the balance of payment, it also shows that how much the frequent policy shift of the RBI, that's called the monetary authority of the country, that the balance of payment will always indicate and shows. The next and the last importance of the balance of payment is it always confirm that the economic, international trade and exchange rate of the currency, which is a which is the same point has been mentioned in the third, that ultimately it's not really international trade but also the exchange rate. So if we talk about the exchange rates of different currencies, the balance of payment always recorded in during a particular period on an annual basis, how much the changes has been occurred and how much the changes has been recovered in that particular period or during that period. It always get to know through the balance of payment or through the concept of balance of payments. The next one is the journal rule in balance of payment accounting. So when we, as I already told, as there is a mathematical formulas of the balance of payment, which is equal to the current account plus capital account minus any balancing items, which will be show up to equalize the receipts and payments in the following term of item, that is errors and omissions. So in the same way, to equalize that particular rule between the receipts and the payments, so if any transaction earns foreign currency for the nation, it is a credit side and always recorded a plus item. So whatever the any transactions has been done or whatever the earning has been received in the foreign currencies for the nation, for example, for the Indian country, any transactions where we earning for foreign currencies, that means it always shows on the credit side and it's recorded as a plus item. The second rule of balance of payment accounting: if a transaction involves a spending of foreign currencies, then it shows on the debit side and recorded as a negative item. Of course, anything we spending foreign currencies, we are doing it the imports, then ultimately it shows on the debit side and recorded as a negative item. That means we deduct whatever the spendings of the currencies for the nation, that recorded as a negative sign. Whatever the earnings of foreign currencies for our own nation, that that comes on credit side and recorded as a plus item. So these are the two rules, a general rule in balance of payment accounting. Let's talk about the various components of the balance of payment statement. So these are the three main categories. The first one is current account, second one is capital account, third one is reserve account, and the fourth one is errors and omissions account. So let's focus one by one and what exact the accounts shows for. The first one is current account balance. So when we talk about the balance of payment on current account, is actually show a statement of the actual receipts and payment in a short period. That means it includes the values, whatever the values of the export and imports, including the visible and invisible items, that exactly the items that shown on the current account. And the particular balances, it could be the surplus balance, it could be the deficit balance in the current account. So surplus would be the positive balance, negative balance would be the deficit balance. It depends. If we talk about the export are more than imports, we talk about surplus. If the import are more than the export, then we talk about the deficit because the earnings are not able to come out. The current account, what are the items that includes in the current account? Talk about the import and export of services. We talk about the whatever the interest rates or the interest you can charge on the import and exports of services. Then we talk about the profits and the dividends, whatever the dividend has been received, whatever the profits has been received, and it's unilateral receipts and payments from and to abroad. So whatever the payments has been received from any of the other countries in terms of export or the any spending that been done to abroad for any imports, that all the items will include under current account. So when we talk about the balance of payment on current account, it includes all the three balances. The first one is merchandise balances. Merchandise balances, we always talk about the visible items balances. Services balances, we always talk about the invisible items because the invisible items includes the services like banking, medical, all that, so on. And unilateral transfer balance. When we talk about the capital transfer balances, we always include under current account. So whatever the balances are incurred, all the items, all the balances will comes under current account. That means the balance of payment on current account, which shows in statement of the receipts and payments in a short period basis. Now we talk about the types of balances, which has been shown in the previous slides. The trade balance, that is called the merchandise balance, income balance, which is called a services balance, and the net neutral back transfers. When we talk about the trade balance, we always talk about the import and export of goods, import and exports of services. But when we talk about the income balance, we talk about the net investment income, that is whatever the income earned from the various long-term assets. We talk about the net compensation of employees, that means the services that we give to some employees, any compensation due to any default being held by the companies. The net neutral transfer, it means whatever the gifts from foreign countries minus whatever the gifts given to the foreign countries. So whatever the gifts received from the foreign countries, that is minus whatever the gifts to the foreign countries. So whatever the difference between the gifts from foreign countries to foreign countries, that exact amount comes from the net neutral transfer. The next balance is the capital account balance. So the capital account balance, it records all the international transactions that involves a residents of the country and deals with the assets and liabilities to a resident of another country. So it means that capital accounts includes the assets or liabilities, which ultimately the any transactions which relate to assets and liabilities, that comes under capital accounts. So automatically, if any transactions goes on in the capital account and that ultimately reflects any change in the stock, where the assets and liability, that all comes into the capital account. That means whatever the difference between the receipts and payments on the account of capital account, and that also includes all the financial transaction in respect of assets and liabilities, that all comes under capital account. For example, the inflows and outflows of cash related to investment, short-term borrowings or lending, any medium-term or long-term borrowings or lending of money, that all comes under capital account. Because ultimately, all these transactions, whether investment or borrowings or lending, it all shows the financial transaction. That means the cash inflows and outflows, which automatically that you have earlier learned in your financial accountings, and it all relates to the financial transactions. And whatever relates to the financial transactions, that automatically comes under capital account balance. Now we talk about the capital account balance. There could be a surplus balance or deficit balance. As always, any account balance have a surplus or deficit. So it always shows on the positive or negative side. So to make it the balance, you always use the term balancing item. Uh, and the item name of that item is errors and omissions to equalize the balance. Now we talk about what are the items, main items which include in the capital account. It's a private foreign loan flow, any movement in the for banking capital, any official capital transaction, any reserves, any gold movement from one country to a foreign country, and that all comes under capital account balance. Because every if we look up, the each and every items all relate to the financial transactions. Of course, the capital account balance is also categorized into two main, that is direct foreign investments and portfolio investment or other capital. If you are making any investment in terms of shares, in terms of debentures, in terms of any other category, in case of the exchanges of the currencies, then it ultimately comes under the direct foreign investments. And the next concept is portfolio investment, which also refers a bundle of investments in different transactions like shares, bonds, any foreign shares or foreign debentures or foreign capital investment in another products of the foreign companies. So that's called the portfolio investment, where you are not deal or restrict with one investment in one company. You can do a bundle of investments in different countries, whether in home domestic industry and the foreign countries. So that ultimately calls the portfolio investments. And the other capital items where the investments come, like for example, the purchase of long-term and short-term assets. So that kind of for the official purpose or for the business purpose, and that also considered the items under capital account, because it's all these three terms. It relates to financial transactions, and the transaction which goes on from one country to another country. The reserve account, the third category of account, that is the reserve account. The reserve account is also called the three accounts. If these three accounts has been collectively used, that account will be called the reserve account. The first one is International Monetary Fund. Second one is special, you can say drawing rights. And the third one is reserve and monetary gold, where the gold has been exported or imported from different countries. That means that's called reserves and monetary gold. So now we come up with these three terms. The International Monetary Fund, where whatever the purchases, whatever you can say the repurchases transaction has been done from the International Monetary Fund account. There is an account where the cash inflows has been recorded for a yearly basis, and that fund account, it's called International Monetary Fund account. So once this account, if any purchases or any repurchases transaction would be occurred, we call International Monetary Fund account, which is comes under reserve account. Any special drawing rights. What is SDR? SDR is also called a reserve asset. Any asset which is kept for a reserve purpose and created by International Monetary Fund, and accordingly it will be allocated to the IMF members countries from time to time, and that's called the special drawing rights. Then any right that you have given to the member countries who are also a member of the International Monetary Fund agencies, and that such rights are only given to them. There is no such rights will not given to any individual, any professional agencies or bodies. No, no rights, such rights will be given to them. Only rights given to them who are belong to International Monetary Fund, or any country, any members who belong to the countries who involved in the International Monetary Fund agencies, then such rights are only given to them. It can be used in such account will be used to settle down the any international payments between the monetary authorities of two different countries. If there is any transaction or any payment is to be done related to the monetary, related to the financially between the two countries, then this account, International Monetary Account, will be used to pay off such payments. That rights called special drawing rights, and of course the International Monetary Fund agencies, where the account has been maintained for the purchases and repurchases, and of course for the international payments to settle down. So such account it's called reserve account, where the reserve and monetary gold are also being collectively involved under such type. Now which is which is being left while reporting the transaction in this account such would be recorded. If any account has to balance off, or there is a needed to show up any of the component like current account balance, capital account balance, you can see this reserve account balance, then this particular account will be used to balancing of such accounts, to balancing of the overstated, the negative balance, or the you can see the positive balance using these three components, that is the capital, current, and the reserve account. That means it's a combination of all to balance such accounts, and that account is called the errors and omissions account. So this is the format. If you look up if there is any balance to be done off, so that means the statistical discrepancies, the term will be denoted and write it down the name, that is errors and omissions account, to just to balance the credit and debit side. So if you look up the terms of the items, the basic how the statement of the receipts and the payment account. So if we talk about export of goods and the payments are import of goods, if we let's trade under the trade account balance, receipt amounts, receipt items and the payment items is already shown on the particular slide or PPTs. And of course, when you talk about the current account balance, this is the exact the items which have been shown 1 to 4 and the payments. And of course, when we talk about the capital borrowing, then again on the payment side, debit side, the investment abroad, short-term lending, medium and long-term lending. So whatever the balances have not been equalized, we term to call statistical discrepancies, that is errors and omissions. Then the third one is any changes in reserve would be the positive, comes under reserve credit side. Any changes of reserve, that is called the negative, it comes under the payment side. And accordingly, once we you can say reveal such items into the credit and the debit side, then we equalize, then exactly the total receipt and total payments will become equal. So this is a format which has been shown over here. Now, how the disequilibrium comes in the balance of payment? A disequilibrium is a situation where the balance of payment, it comes in a particular condition of surplus or deficit. So when we talk about any surplus in the balance of payment, when the total receipts is more than the total payments, that means credit side is more than the debit side, that's called surplus. When we talk about the deficit, when total payments, that means the debit side is more than the credit side, or in other words, the credit side is less than the debit side, it's called deficit. That means a deficit situation arises in the balance of payment, and that's called a deficit in the balance of payment, where the credit side is less than the debit side. So this is a true disequilibrium condition. And why the disequilibrium occurs? So if there is any situation occurred in such, then it's called disequilibrium. Causes. What are the causes of disequilibrium in the balance of payment? Cyclical fluctuations would be going on in terms of prices, in terms of demand, in terms of supply of the goods and services. So when we talk about the disequilibrium, how the disequilibrium would occur, because when there is a shortfall in the exports, when there is no more exports it's going on in the country, no you can say earning has been received in terms of foreign currencies for the nation, then disequilibrium situation would arise. Economic development. So where when we talk about the development, we need earnings. When there is no more earnings coming up for the nation in terms of foreign currencies, and economic development will not mean you can say increasingly or you can say putting in efforts by the government. You can see if the population is increasingly day to day, and then ultimately it leads to disequilibrium when it comes to the spending and earnings. Structural changes, when we talk about the policies, when we talk about the plans of the of any of the country, it would also influence the visible, non-visible import and export of goods and services, or any of the you can say the lending and the borrowing process, and ultimately if it leads to disequilibrium in the balance of payment. Natural calamities will also influence the economic balance of payment because nobody knows what exactly comes within a second. It would be earthquake, it would be cyclone, it would be typhoon. So that's called the natural calamity. It would be floods also. So ultimately, it influences the country or the economy balance of payment. International capital movements is also you can see one of the cause of disequilibrium, as there is a flow of capital, a flow of investments from one country to another country to their domestic monitoring authorities. So it also leads to the disequilibrium. Measures to correct disequilibrium in the balance of payment. The first category is the monetary measures. The first is monetary policy. Of course, monetary policy is always related to the money supply and the credit in the economy, and ultimately, the central bank will always help out about the expand and the contract of the money supply in the economy through the considering the various measures will automatically affect the prices. So that is also the one of the measures so that the situation of disequilibrium comes into an equilibrium. Fiscal policy. Fiscal policy, of course, it is a government policy which is based on income and expenditure. That means the government always try to focus on the developmental or the non-developmental expenditure, where when they once they get the income from taxation on the non-tax sources, then automatically the expenditure, the government expenditure will be possible in developing and you can see the particular economy of the country. And accordingly, in such situation, when the income they get the income from taxation, the government expenditure may be increase and decrease when it comes to expanding for any economic development. Next one is exchange rate depreciation. Of course, there is also another way to reduce or to improve the disequilibrium situation. So once you reduce the domestic currency, the value of a domestic currency, so the government can easily correct the disequilibrium in the balance of payment. So automatically, once the exchange rate will get decreased, so automatically it also reduce the value of a home currency as compared to the foreign currency. So as a result, imports become costly and the export becomes cheaper. So when we talk about the import, definitely will be costlier. So automatically in the country there would be a situation called the inflationary trends in the country when the inflation would come up whereas the imports become costly. So this is the one of the measure to reduce or to improve the disequilibrium in the balance of payment. The next one is devaluation. Devaluation is always lowering the exchange value of the official currency. So if we talk about the Indian rupees, so automatically when we talk about devaluation, it's lowering our own value of the currency. So when the country devalues its own currency, the export becomes cheaper and the import becomes more and more expensive because as there is a need to reduce the balance of payment deficit that which also leads to disequilibrium in the balance of payment. So devaluation is also the one of the measure to correct disequilibrium. To reduce the exchange rate is also the measure to improve the disequilibrium situation that arise from the balance of payment. The next one is deflation. Deflation is also the one of the measure to reduce the quantity of money or to reduce the prices and income. So when we talk about the domestic market and the currency has been deflate. So of course the income of the people will also decrease as the quantity of money is already reduced. So automatically the consumption will be put a hold on that so that the government can increase export and earn more and more foreign exchange. The next one is exchange control. So whatever the exporters exist in the in the own country, so all exporters are always directed by the RBI to surrender the foreign exchange earnings so that the total available foreign exchange will be the license will be given to those who obtained a license from the government in case of imports. So only the license holder can import any good, but the amount will be the fixed by the monetary authority of those countries. So that's called if we control the exchange of goods by putting up a license. Because in India there are so many exporters who don't have a license, but still they are actually really in doing the business of import and exports. So it is very important to reduce the disequilibrium. The license holder would can only import any good if but in a limited extent, which has been fixed by the monetary measures as well export promotion. To control the export promotion, the country can also take up measures or adopt measures to stabilize exports like export duties, any cash assistance or subsidies to given to the exporters to increase exports, and goods which are meant for export are exempted from all the types of taxes. That means there is no taxes to be imposed on those goods which are meant for export. That is also the one of the measure to improve the disequilibrium situation. Next one is import substitute. There are plenty of the steps are to be taken to encourage the production of import substitutes. That means if the demand of one good, you can say it's not possible for the import, then another similar good would be possible to go for import option. So ultimately, it will save a foreign exchange in the short run if we by replacing the use of imports by these import substitutes. So if any good which is not available, so there is the another good would always be ready to substitute to increase that demand for the imports in the home country to save the foreign exchange in the short period. So this is also the one of the measure to correct disequilibrium in the balance of payment. The next one is import control. So import control can be done through two ways: quotas and tariffs. Under the quota system, government will always fix and permit the maximum quantity or the value which is being imported during that particular period. So restricting imports through quotas, the deficit can be reduced and the balance of payment situation can be improved. Tariffs are the duties, the taxes which is being imposed on imports of goods. So automatically there is some goods which where the taxes would not be imposed. So if the tariff are imposed, the prices of imports would get increased, and the prices would get a decrease of those imported goods which have a huge demand, and ultimately the domestic producer will always induce to produce more and more goods in our home country. So automatically there is also another way where we improve the disequilibrium. That is, tariff will improve the disequilibrium in the balance of payment. This is the current situation of balance of payment of India. The current account deficit in quarter 1 is US dollar 7.8 million. Then again, there is an improvement in the merchandise trade visible items, that is 34.2 billion has been achieved. Then again, there is a reduction in the current account deficit by having a huge net earnings. Then private transfer receipts is also get improved in India as compared to overseas and earned a 16.2 billion. That means a little margin decline as compared to the last year. So this is the portfolios of the you can see balance of payments in India. Non-residents deposit has been increased as 5.9 billion as compared to the last year. Net loans has also come in an inflow, that is the 5.4 billions. That means that transactions, the loan has been recovered. In 2000, April and June 15 also, there is also a net accretion. That means there is an increase of Indian foreign exchange. This amount increase in reserve account as compared to the last year. So these are the several reasons sometimes in the Indian poor performances, that is the higher purchases, poor quality, poor negotiation skills, inadequate promotion, and the poor follow-ups of sales. So this is the data which has been shown in this on the screen. And ultimately it shows the poor performances when it comes to the Indian export trade. Then there is a reason for the export trade, that is the domestic market is good, number of formalities is more for you can say different marketers, so of course the formalities to be simplified. Problem of trading blocks, negative attitudes towards the buyers or overseas buyers, poor infrastructure, as Indian infrastructure is very poor. So Indian exporters always find it difficult to get order and deliver them at or on time. So when we talk about the money, money is just a medium of exchange where the goods and services are exchanged for 1 unit of currencies, or you can say 1 unit of Indian currency. If you talk about, if I want to buy 1 kg apples, that means whatever the unit of 1 unit in rupees, it could be the 80 rupees, and 80 rupees is called a medium of exchange of good for money. So that is called the exact definition of money, that the central bank and the government of the country creates and issues money, whether it would be the notes, it would be the coins, it would be any cash money. And of course, there is a legal tender and legal compulsion on citizens to accept it and use it for their own survival. So that's it for today. So whatever the important topics will come up, which is left in the last block, will come up in the next upcoming session. So till time, thank you for listening this session, and namaste to all.